Hi, and welcome to the Macro Show. We talk macro, and you wonder, is a hedge fund really getting liquidated? Oh, yes. We're going to talk about that. Can Wells Fargo save the bond market? They can. I'll show you how they can do that. What drove the bond Treasury yields higher today? I got information on that. Got a great show lined up for you today. I'm your host, Steven Van Metre, and thanks for joining me today. Now, some of you have been following the story that broke Friday that a hedge fund was getting liquidated. Now, how do you kind of know that's what it looks like? And you can see there was just massive selling in small caps. There was a late day bizarre ramp, and then this morning more selling in small caps. And you can kind of see that trend across the markets. Now, for those of you who are not following the news story and you don't understand, like, how does a hedge fund get liquidated? And how could this even be possible? Well, we want to talk about this thing called margin debt. And we've shown this slide before, and that's not the slide. This is the slide here where we can see real margin debt, the slide provided by Advisor Perspectives. You see margin debt just shot straight up from the bottom of the pandemic, potentially due to the SLR exemption as banks, just lent out a ton of money, and that brought equity market higher. It wasn't this inflation trade, it was a debt trade. It was a margin trade. So how does this work? So a large hedge fund, some of you trade on margin, so you know how this works, is you borrow money and you buy stocks. Now, let's just say that for some reason down the road, you cannot meet your margin requirement. You can't pay the interest on it. And it turns out those stocks you bought, well, you didn't make the best decision and they went down. So what happens now? The bank then calls in its loan and says, hey, look, you're not making your payments. We are going to close out your margin. And then the bank looks at your positions and finds out that at least two banks that we know of are going to take a combined $6 billion in losses, and that's substantial. So what does the bank do? It starts to liquidate. And how fast? Fast. Whatever, and everything. Just sell good, bad, get those positions sold, because now the problem is the hedge fund owes X and they only have Y. They have less, and that leads to further forced selling of the hedge fund's other assets. And so that's when you see markets start to irrationally move. It's due to margin debt. And that's why when we look at this slide, and one of the things that concerns me about this run up in margin debt in the weakest expansion in the history of this country is that when this debt does get unwound, it's going to be dangerous for the market because there's not a lot of liquidity. And what does liquidity mean in this case? It just means there's not a lot of money sloshing around for people to absorb all the selling. There aren't a lot of people that are going to want these things in a forced sale environment. So does this have something to do with the SLR exemption coming up? I don't know. There's not a ton of information on exactly what's going on. We just know that a hedge fund's getting liquidated, and some banks are taking, primary dealer banks are taking a hit on that. Could there be more to come? Well, we've already heard, don't worry, this is contained. Don't worry, the last time we heard this was contained was, right before the great financial crisis. Exactly. All right, can Wells Fargo save the bond market? Now, this piece comes from Credit Suisse from Zoltan Pozar and his report from the Global Money Dispatch. Now, let's take a look and see that we show how the rates market would benefit if Wells Fargo growth ban was ended. So what's happened now is Wells Fargo's been on a ban. It's going to be interesting. If you haven't read this, wait till you see who put the ban on Wells Fargo in place. So what's been going on is Wells Fargo's total on-balance sheet assets, at the holding company level have been flat during the pandemic, and the bank's subsidiaries loan book has been shrinking. The bank's deposit growth at $100 billion was meager, and half this growth replaced the more expensive funding from the FHLB system. In sharp contrast, other banks increased deposits and assets by $200 to $700 billion last year. So he says, second, the growth ban precluded Wells Fargo from funding the war effort. Now, what does he talk about? The war effort, he talks about buying bonds. And there's some charts, we're not going to go through them, that show the bank added no treasuries last year. So Wells Fargo added no treasuries on net, while its peers added $300 billion in treasuries, buying mostly long-term notes. Now, let's talk about this because some of you said, wait a minute, Steve, you said banks don't buy long-term bonds, and then you said they do, and then you don't. You're confusing us. All right, so from a deposit perspective, when you deposit money into the commercial banking system, it gets converted to a reserve. That reserve is tied to a U.S. Treasury security of somewhere between, say, 4 weeks maturity and 7 years, with the average somewhere between 3 to 5 if it's a commercial deposit or it's a consumer deposit. The time the bank thinks that money is going to be on deposit is a little bit different. So from a deposit perspective, bank would not buy the long bond because they're not anticipating anyone having money there for 30 years. Now, you might have money there for 30 years, but that's not their expectation. Now, on the other end of the spectrum, bank is going to lend money to make money. But there's an alternative, because we've gone through all these laws to say, or these regulations say, look, bank, you can lend money and you're going to get penalized for that. But if you'd rather, you can buy a Treasury security and there's no penalty for that and have all those you want. Now, in that case, the bank would look to buying a long bond because it would want to get the most interest for its investment. Does that make sense? All right, let's go back. If the U.S. financial system were a Boeing 747, this was the old ones that I don't know if too many are flying anymore, that have the 4 engines flying through a fiscal storm. It's been flying with 3 engines, JP Morgan, Citibank, and Bank of America, and the 4th engine, Wells Fargo, has been offline. Oddly, the 4th engine has more thrust than the others combined. Chart 6 shows that Wells Fargo has a capacity to add $400 billion of some mix of reserves. These would be reserve assets from the Fed and Treasuries, while the other banks, once their G-SIB constraints are factored in, have none, which will assume that the Fed's going to adjust the G-SIB constraints by the end of the year when they do their G-SIB review. Third, Wells Fargo asset growth band is starting to constrain other large banks. For example, JP Morgan's SLR and G-SIB's issues are partially due to the fact that the 4th engine is offline, and so the JP Morgan engine is being pushed to the limits to keep the 747 airborne. At the same level, the answer to this is not to ignore the limits, SLR and G-SIB reform, but to turn on what's offline. Now, this is what's great. The Fed reported approval of Wells Fargo's capital plan in mid-February is the first step to removing the asset growth ban. The fact this approval came less than a month after Secretary Yellen got in her seat may mean the Treasury and the Fed are coordinating to bring more capacity online to absorb treasuries, which would make sense, right? They've got to get someone to buy these treasuries, and by regulation, the banks are going to do it. Get this, Chair Yellen, former Fed Chair Yellen, this is when this ban went into place. Chair Yellen imposed a ban on Wells Fargo, and Secretary Yellen needs that ban lifted. A $200 billion bid for treasuries from Wells Fargo would improve the bid for treasuries across the curve. And wow, isn't that interesting that, you know, when Janet Yellen was Fed chair, she put a ban on Wells Fargo, and now she realized, oh, wait, maybe I need someone to come in and buy all these bonds I'm issuing. That's pretty great, right? So I imagine that. I don't know when that's coming. I thought that was really interesting, and we'll expect that. I'm sure they will be working to get that 4th engine back online as quickly as possible, and that would be great for the bond kingdom. All right, so what drove the bond market today? So I want to show you the chart of TLT. Some people ask, why do you use TLT? It's just the largest traded Treasury ETF. There's no particular reason. There are other ones. You're welcome to use any one you like. But what happened today, and we'll zoom in, is after a nice little overnight rally, it got hammered right into open, went sideways, consolidated, and then hammer, and then went up. So what was going on? Is computer models, CTA models, were shorting the Bund, the German Bund. Now, how do I? Well, I know that. You just have to work with me that I know this. Now, there's another way to tell that it wasn't just normal Treasury selling, is because the volume was low. In fact, it wasn't until that last hour of trading the volume even got above that low from Friday. So we know it wasn't hitting the Treasury market, but why would selling of German Bunds affect the Treasury market? Because right now the global economy, the global bond market, sovereign debt market is all interlinked. So if one's going down, the other one's going down. One's going up, the other one's going up, which surprises me. And I wonder why the European Central Bank is not doing more, or the Bank of Japan, both which have capacity to buy foreign debt and drive yields down. They're not doing much. I mean, I don't know why. I think they should. And maybe they're waiting for something great. Maybe they're waiting for that 4th engine from Wells Fargo to come back online. I don't know. All right, let's get into what else we've got. The Texas Manufacturing Outlook survey from today. This is up. Now, if you're wondering about Texas manufacturing surveys, Think oil prices. Oil's up? Yep. Well, guess what? Things are going to look a lot better in Texas. One thing I wanted to take a quick look at is prices paid for raw materials. 55% of firms on net reported higher prices. And impressively, 44% said they got higher prices. Now, it doesn't say that it didn't show the percentage change. It just said 44% of firms got higher prices. All right, let's take a look at, look, it means they're trying to pass on. We just don't know if they're able to pass on those price increases. We know that they're not going to be able to pass all of them on. Let's take a look at how hedge funds are positioned in the futures market. We see the 10-year Treasury up slightly net long. Let's look at the long bond. They're backing off their shorts again. Now let's go to our friend Brent Johnson from Santiago Capital, who says, wow, the non-commercials were really covering quite a bit, 15,500 contracts. We're actually seeing the commercials increase their short position. So the short, if you look at, for some reason, the commercial traders have not backed off their shorts. I imagine at some point they will. And here's a bigger picture of that chart showing the net speculative short position is backing off. It's still deeply short. There's still a lot of shorts on the bond market. And then we turn to our friend Stefan from Skyway Asset Management. He takes all those positions that Brent has here, all of these here, and he likes to look at them from a total net long or short. As you know, we looked at this and he says, look, this is really, in his note to me, he says this is super bullish for the bond market because you're seeing on net people taking a long position here. He says that by the third quarter, he expects bond prices to be significantly higher. All right, let's go back to Hedgeopia here and see what else we've got. Despite oil prices being relatively high, the speculative positioning is unchanged. So it looks like speculators seem to be fairly happy there. S&P 500 are net short going into last week. And how about the euro? The euro is a thorn in the dollar side, thorn in the bond kingdom side, and euro up slightly on the net speculative long positions. But we want, hey, if you're rooting for the bond king, you want that euro position to go down, down, down. How about gold? You see a slight decrease in net longs, not a huge amount of change. I do expect, as you know, gold to go lower. I'm bearish on gold in the short term. Of course, my range of what short-term is and long-term, I think some of you are realizing is a lot different than what your view of short and long-term are. My long-term views are out 3 to 5 years out. How about Nasdaq 100, still slightly net short. Russell 2000 backed off their longs a little bit. But the dollar, let's see. No real change in the dollar here, but the dollar is really poised. If you watch the Sunday chart show, you really saw the dollar is just really poised to take off. Maybe if we have a minute, we'll take a look at that, see how it did today. And they're backing off their VIX, their volatility shorts, which is kind of interesting. I mean, volatility's been falling mainly due to just this forced buying we've seen from some quant machines coming in and buying. They hit their trigger points on their vol control strategies. And they're being forced to buy, driving vol down to the point where speculators are backing off. So be curious if they jump on that bandwagon and drive it even more short this time next week. All right, how about that chart that I meant to show you last week, but I forgot? How about this? Is cash assets. Now you see there's a minus sign, so it's cash assets at all commercial banks shown inverted. So when it's going down, that means cash assets are rising. And so you see cash assets, which do include loans to money due from the Federal Reserve banks, think reserve assets or QE. And what do you have on the other side? We have 30-year Treasury. So you'll notice that when cash assets at banks are rising, shown falling, and you see 30-year yields rising, that increase in 30-year yields will get rejected. And you see it every time. Hey, there's going to be inflation. No, rejected. And then here you see, there's going to be inflation, and cash assets at bank are piling up. That is a disinflationary or deflationary move. I mean, when cash is piling up at the banks, people think, well, that's got to be inflationary. Now, tomorrow I sit down with Eric Townsend from Macro Voices for my interview that of all days will air on April 1st. We're going to talk a lot more about this chart and why this cash piling up in banks is not coming out. I will have these charts available for you. And of course, as many of you who are fans of Macro Voices already know, it's totally free. So I'll keep you appraised on that. I've got about 8 charts that we're going to go through like this and really see if I can convince Eric. I'm not sure I'll be able to, but if I can even put a small doubt in his mind that perhaps this inflation trade is going to roll over. And when you look at this chart, it starts to make a lot of sense because cash is not coming out of the banking system. We're going to explain that. If you happen to listen to the Daniel DiMartino Booth and Dr. Lacey Hunt interview on Real Vision, you heard him say that money's getting tied up in the banking system. Well, we're going to get deep into that. All right, let's take a look at the dollar since we talked about that and see what's going on today. We got a few minutes. It's not a lot of economic data to cover today, but look at that. It hit its 200-day moving average, bounced off it. It's sitting right under this little zone of support at 90, just say 93. Remember, the next move for me on the dollar is where we start to see some volume support is at 94. Now, what happens after that? Now, keep in mind, the dollar is the same place it was 6 years ago. People are super dollar bullish. I don't know why. But anyways, you can see once it gets over 94, there's this gap between zones. See this supply zone here, and price moves quickly through these supply zones. And so you can see this move down is likely going to be a fairly quick move higher. So I'm looking at the dollar to get through 94, and then from 94, a quick move up into somewhere around 97-ish. And you want to see the equity market fall apart. From a bond perspective, a rising dollar is really important because if you're in a foreign country, say you're a Japanese central bank or investor or insurance company, and you're looking for yield right now, well, if you're going to buy a U.S. Treasury security, you have to hedge that in the foreign currency market so you don't get your teeth punched in if there's a big move in the currency. Well, a rising dollar brings that cost of insurance down, and with U.S. Treasury yields relatively high compared to other parts of the world, it makes them really attractive. So that's why I'm really dollar bullish here, because the dollar gets going, the bond market's going to find a lot of buyers it hasn't seen in a while. Anyways, thanks for being fans. Thanks for watching. We'll be back on Wednesday for the macro show, where I'm sure we'll have some interesting stuff to talk about. I'm your host, Steven Van Metre. Bye now. The content of this video is provided as educational information only. It is not intended to provide investment or other advice. Serial is not to be construed as a recommendation or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial.